Thank you very much, Steve, for your introductions. Welcome all to the most anticipated plenary session of our forum, which is just stuffed with intellect and experience and knowledge that we are keen here to share with you. We're running a little late, so I'll be as efficient, as effective I can be in moderating the discussion. I'm extraordinarily pleased to welcome to the podium truly four distinguished speakers, starting with Dr. Willem Buiter to my immediate left, Citibank Chief Economist for the United States, former professor at London School of Economics, graduate of both Cambridge and Yale, former chief economist for the European Bank of Reconstruction and Development, former senior advisor, external advisor to the Bank of England, and the commander of the British Empire. Ladies and gentlemen, Dr. Buiter, thank you very much for joining us. Next to Dr. Buiter, Dr. Herman Daams, chairman of BNP Paribas Fortis Bank in Belgium, chairman of the board of KU Leuven, who has chaired numerous, and I emphasize numerous, boards of venture capital, private equity, financial sponsors, and educational boards across Europe. And is also a former chair of Belgian Corporate Governance Committee and has dedicated his lifelong career also to serving his alma mater, KU Leuven. Welcome, Dr. Daams. Next to Dr. Daams, Justin Gionta, Chairman and CEO of the Lotte Group, Executive Vice President of African Business Roundtable based in South Africa, originally from Zambia. Justin is a 25-year-old veteran of investment bankers focused on structured trade, corporate finance, project finance, and really one of the greatest champions of debt capital markets and investment banking Africa has ever had. So I'm immensely proud to welcome him to the stage and also acknowledge his role as a pioneer of General Colin Powell and Ms. Madeleine Albright's initiative for global development Frontier 100 CEOs and a former executive of Citibank and HSBC in the region. And to my furthest right, Dr. Warren Jestin, Chief Economist for the Bank of Nova Scotia, based in Toronto. He's a world-renowned expert on the Americas, member of many non-for-profit organizations and educational institutions, economist in residence at the University of Guelph, member of C.D. Howe Institute's Monetary Policy Council, the Canadian Foundation for Economic Education, Canadian Ontario Chambers of Commerce, and the Toronto Board of Trade. And on a personal one, somebody who I've looked up to for a very long time, and I'm privileged to call both a friend and a mentor. Ladies and gentlemen, please acknowledge the wonderful panel of executives here with me on stage. And my name is Chris Jamroz. I'm President and CEO of Garda World Cash Services. My job is to make sure that the cash flows fluidly in the society, and every time any folks or businesses in the United States or Canada need the cash in ATMs, banking branches, restaurants, governments, it's our job to do that. We do that in partnership with some great financial partners here represented by Bank of America, who were in the capacity of the true thought leader, has made it very possible for our growth and serving both countries from that perspective. And thank you again for the wonderful reception last night, Fabiola. On what I also wanted to thank to all of you, my friends and colleagues who have texted me that my companion to my left, Dr. Buiter, is in his thesis of abolishing the cash, and no, I will not challenge him on it. We all read it, but you should know that Dr. Buiter is known for his probing mind and shattering the status quo and the courage of convictions. And he told me last night at dinner that he has not received as much hate mail after that article on abolishment of cash since he called the gold a 6,000-year-old bubble. So he's not a stranger to controversy. But speaking of that, Dr. Buiter, we're looking at the global economic outlook for the world this year in 2015. We're looking at some signs of a slowdown coming from regions that, even a couple of years ago, you wouldn't have expected any trouble to come whatsoever. In your opinion, are we moving out of the economic crisis, or are we moving closer to the economic stagnation?
Well, they're not mutually inconsistent, right? We can move out of crisis into stagnation, which would be an unfortunate form of progress. But I think we are certainly, at least in most of the world, moving out of crisis. Of course, there'll be future crises, right? There's no world imaginable that doesn't have crisis. But we'll be all right for a bit longer, except possibly in Europe, where Greece could flare up at any time and create a crisis, although that's not the most likely outcome. But what we're moving to seems to be a period of mediocre growth. Not the kind of growth that we associated with the years before 2008, when global growth, say, depending which measure you use, at market exchange rates, say, was between 4.5% and 5% for some years. We're now looking at 3%. Right? That's last year we had slightly less than that. That's actually, in my view, slightly below potential, and potential itself is disappointing. The main drag on growth at the moment is the emerging markets, which is what's new. Almost all leading emerging markets are slowing down, or are slowing down faster. Most notoriously China, which is a global risk factor that could threaten even mediocre recovery we still have. But the only main exception to the slowdown in emerging markets is India. Right? Sub-Saharan Africa is also doing better than most of the rest of the advanced economies. But LATAM has slowed down, especially Brazil, as I said, China, South Africa, in other parts of Southeast Asia, and in the advanced economies there has been not enough to offset it. Yes, for the first time in 5 years there is a pulse in Europe, right? We're having a cyclical recovery. No, thank you. But 2 years of cyclical recovery at 1.5 to 2%, which what I hope for, gets us back to potential output, which is 0.8% growth, which is pathetic. Right? The US last year, we expected 3% growth. We got 2.25. Everybody said it was Frosty the Snowman. Again, this first quarter seems to be lost. Is this to be the pattern, that we lose a quarter and don't gain it back? If we undershoot 3 again this year, this might be looking like a pattern. So I'm concerned that, yes, the world is slowing down to something closer to Larry Summers' cyclical stagnation. It is, however, a collective choice. It is not a necessity. We have the fate in our collective hands. The problem is there are no collective hands, there are national hands, and they don't tend to work together.
Thank you very much. Dr. Dam, speaking of the pulse in Europe, the deflating or increasing pace of growth in the economy for the second part of our decade in the Eurozone.
Let me first of all say that my comments are based as coming from a board position, not really as an economic analyst as Willem is, or as a policymaker. And when I look at Europe from a board position, I say Europe will do what it has done always. It will surprise positively, and it will disappoint negatively. The surprise positively, I think, will be that indeed, I think the general expectation is that economic activity will go up for a number of reasons. First of all, consumer demand will go up, helped in part by the fact that the oil prices has been going down and creating some opportunities for consumer spending. Second, we hope a lot for a stimulus of export demand, helped by the fact that competitiveness is improving because of the decline of the Europe. Two concerns on the demand components is that the fact that CapEx remains very low in Europe, partly because of the slow economic activity, also because of the political uncertainty, something I will come back maybe to a little bit later. And fourthly, the fourth component of demand, government spending. There is no room for government spending. That is my first positive surprise. I think we will get to something better. The second positive surprise is that the European Central Bank is taking on a role. It is really going for trying to create a credible commitment for the 2% inflation rate. It is trying to help the transmission of monetary instruments into the real economy. And thirdly, the European Central Bank is helping the politicians by creating this increase in the money supply and lowering the interest rates by forcing them, I hope, to do some structural adjustments. The second, the two last surprises that I want to mention is, despite to what everyone thinks, I see indications that entrepreneurship in Europe is improving. I see a lot of young people who are really trying, and in a lot of cities, Berlin, Paris, I see that also in Belgium and in the Netherlands. I see a lot of stimulus there in trying to create entrepreneurship. And the fourth positive thing is, I think there is beginning a debate to deal with some of the social ills of Europe, dealing with the labor market rigidities, dealing some with the bloated governments and so on. What are going to be the disappointments? The disappointment, as always in Europe, it's going to take a lot more time than we anticipate. So you all hope this is going to happen in 6 months. This will not happen in 6 months. This will take. But on a more serious note, and I worry about the timing, but on a more serious note, there are two concerns, two possible disappointments. That is a political one, and Willem already referred to the Grexit. I think the Grexit will be Grexit, for those of you who are not familiar with the jargon, is the fact that Greece may be forced to leave the euro. I think it will not be a major disturbance, and it will, in fact, the Greeks, I think, will revisit the whole process. But there are other things. There is the elections coming up in the UK, which may create a period of uncertainty about the stability of Europe and the Eurozone. Will there be a UK exit or not? I don't think there will be one, but there will be a debate. And then thirdly, something that we hardly discuss in Europe, at least not in the core of Europe, but is very much a concern in a number of countries, is the situation in the Ukraine and is the situation with Russia. So I see a number of positive things for Europe. I see a number of concerns. And that, I think, sums up what I think about Europe. Thank you.
Thank you very much. So speaking of things taking time and the pulse, Justin, you've kept your finger firmly on the pulse of Africa for 2.5 decades. In the absence of Brazil, in the absence of China in 2015, to bring us excitement, what should be looking and what should be expecting from your region, and where are the best areas for investors to look into?
Great. Well, fortunately for me, I come with the good news first. As you know, Africa is home to 7 of the 10 fastest growing economies. It basically has been focusing itself on what is called regional economic communities. And if you look at the eastern side, there's a community called the Common Market for Eastern and Southern Africa, COMESA, which has almost 400 million people gathered under one's economic structure or zone. And if you look on the West African side, there's another community called the Economic Community of West African States, which has another 300 million people that are gathered under that structure. So what we're beginning to see very actively and very positively is that non-commodity based growth, for instance, is beginning to be a key driver of most African economies. McKinsey did a report a few years back, I think, about the African lions. And one of the things that came out emphatically in that is that retail commerce, for instance, telecommunications, infrastructure, and the whole trend of urbanization, a very young and urban population that is growing, is throwing up huge opportunities in construction and other activities that basically are consumer-based and are possibly going to be pushing the continent. So I come with a very optimistic perspective on that. Having optimism, however, we need to temper it with a little bit of realism as well. Because last year, I think the big news that everybody seems to focus on is a little bit on the negative, which is on the health scare that happened in West Africa. I think you heard about the Ebola scare. Although that was mostly in 3 African countries, Guinea, Liberia, and Sierra Leone, I was very surprised when somebody told me that South African tourism numbers have gone under because people are scared of Ebola. So I think one of the key things that, if I will leave anything with this audience, is that Africa is made up of 54 African countries. And of these 54 African countries, as I mentioned earlier, 7 of the 10 fastest growing ones are coming from there. And these countries are probably countries that have not been on most people's beepers. Ethiopia, Mozambique, Tanzania, mostly these are all, these are part of the new growth that is being leveraged across Africa. So yes, I have optimism. Again, I also remember another thing from last night's sessions, which was, I think it was Prime Minister Shaukat Aziz who talked about it. I think other than the public health scare that's happening, there's also a little bit of something to watch, which is what's happening on the global terrorism stage, especially the non-state actors. We heard about ISIS last night. I think if you heard recently, in Libya, ISIS basically has been creating certain zones there. We also have in Nigeria a non-state actor called Boko Haram, which is fairly active. And then sadly on the East African side, we have the Al-Shabaab, which has also been heading in the direction of the Al-Qaeda type jihadists. So I think, yes, there's optimism, but there's also cautious optimism. But even more importantly, in terms of looking at some of the things that are probably likely to negatively impact us, we also ought to go behind a little and look at, what are the root causes of some of those things. The economic disparities that most people see, the sense of economic injustice, because I think one of the reports, I think it's the last World Bank report, the emphasis is on growth with equitability as opposed to just pure growth now. So I think that's really the direction that we're heading.
Thank you very much. Yeah. Dr. Jestin, so speaking around the pulse thing, a few Canadian executives, I think, must have been connected to heart monitors after what happened to the oil prices in the Q4 of last year. And on a broader American perspective, the change of focus in China from an infrastructure, capital, credit-driven investment to more of a stable, consumer-driven economy has a broader impact on the Americas. But what does that mean to us? How should we be thinking about that?
Well, the first thing I think you got to realize is that economists are better storytellers than forecasters sometimes. And the oil shock, of course, brought that forward to us very, very quickly. The world is changing. The world is changing very rapidly. The fact that oil fell by more than half in a very short period of time created a new set of winners and losers from an economic and financial market sense. We see the world as going through two things simultaneously. One, a profound structural change, and we've heard a bit about that already. The opportunities in Africa, what's happening in China, the slowdown itself is built on a society where wealth is increasing very rapidly. an economy that will exit this decade arguably the biggest economy in the world according to the IMF, the biggest market for luxury goods in the world, biggest influence on resources, biggest supply of tourist dollars in the world. I could go on and on and on and on and on. If you've got gold in your portfolio, pay attention to what's happening in China and India. That structural story is continuing, and we have literally billions of people that are entering a market that will be an opportunity for the Americas. There's no doubt about that. And the focus right now is on the cyclical recovery, if you would like to use that word, and it's more than a recovery because it's an expansion. In the US, the hopes of a recovery in Europe, although with no population growth and still heavy debt loads, and a generation left behind by sky-high youth unemployment rates, the headwinds are remarkable there. But the US has become the focus of investor attention now, because the type of shocks that we see in the global the oil markets, what we're seeing in the Ukraine or with ISIS and the like, tend to make investors very risk averse. And as a result, whether it's the US equity market or a bond market, and the fact that the US economy itself is really invigorating itself, tend to attract capital in. That's the reason why the Federal Reserve could exit a market which 2 years ago was buying $1 trillion worth of government bonds and mortgage-backed securities, and go to zero after November, and interest rates went down, not up, very substantially. So I think when we look ahead, the oil shock has taught us that resilience matters, balance sheet strength is important, economic and financial efficiency in markets is absolutely essential longer term. That where the puck is going, this is typically a Canadian example rather than where it is right now, is the emerging world, because that's where the markets are being created. But in the here and now, over the next couple of years, the biggest influence on the Americas in a positive way is going to be the US recovery. A lot of pent-up demand, a lot of income growth, a lot of employment growth. And I strongly believe that a year from now when we're talking, that story will be sustained.
Thank you very much. So I have a few questions now for all of you gentlemen, and talking about the challenges to growth, thinking about the sort of short term and the longer term, more of a structural challenge that we have to overcome. What are the biggest risks, Dr. Buser, that kind of you see on your radar screen with a short term and long term perspective?
Well, the main risk I see, apart from that US growth could disappoint in the short run, is that we are at risk of taking globalization for granted. And I think globalization is actually under threat. We have had fantastic global growth since the end of World War II, really, when first the West sort of reindustrialized, recovered from isolationism since the First World War, the Great Depression. Then communism was kind enough to collapse, and then China and India entered the global economy. Africa came in, and we've never seen anything like it. Right? But growth of trade is now barely in excess of growth of world GDP. For 40 years, it was more than twice that, and I don't think it's all cyclical. The G20 in 2008 stood up and said, we are not going to make the mistake they made in the 30s. We're not going to have protectionism. And the G20 heads of state went home and had more protectionist measures than we've seen since 1950, right, in the G20. Not as bad as it could have been much worse. It was not the 30s, but it was still bad. We've had, of course, an enormous whack against cross-border banking, partly as a result of the crisis. You know the pattern. 10 years of under-regulation, big financial crisis, 10 years of over-regulation, which we are now. On average, it's perfect, and it's always wrong, right? And this is, NAFTA, which I think is the greatest success of the last 30 years in trade. Both the left of the Democratic Party and the Tea Party wing of the Republicans are dumping on it, saying it's terrible. I think let's hear it for NAFTA. Let's hear it for the TPP. Let's get that thing going. Let's hear it for the TTIP, the Transatlantic Investment and Trade Partnership. But to do that, first the president has to have the Trade Promotion Authority, the TPA. And the Congress may not give him that. So let's not take it for granted. anti-immigrant sentiment, which is rampant everywhere, in the US, in Europe, in Japan, where it goes beyond anti-immigrant sentiment, and just don't let anybody in. We really have a problem here. I'm a professional immigrant myself, right? 4 people in my nuclear family, born in 4 different countries, 3 continents, and we have 10 passports between the 4 of us. So, I really take this personally as well. But it is an issue. We have segmentation of the internet, the Great Firewall of China. So don't take it for granted. Globalization has losers. And unless we recognize that and compensate them or make it possible for them to respond positively, they are going to organize in populist backlashes against globalization. Globalization may have increased inequality, right? And in that case, let's use domestic instruments, which is all we have, to address that. I want to end with this final remark. It is both true that inequality appears to have increased in almost every country in the world, and global inequality has gone way down. Now, think about that.
Dr. Jeston, your perspective on the risks to short-term and long-term growth.
Well, interestingly, I think I'll start with the end result of Dr. Willem's proposal. Inequality is going to be a key driver of risk across the continent. So I think to the extent that there's political will to tackle it, it will also be a great mitigant. Because there's a research think tank called the Afrobarometer. When they recently published their key thought process on the 3 key policy steps being taken by African governments, those 3 happen to all be in areas which would tell us something about how they're looking at this. Unemployment, public health, and principally unemployment and public health were the 2 key ones which drove everything else. Now, if you look at that then, it tells you that a lot of the risks, at least from our perspectives, are going to be basically social and to some extent economic, in the sense of how do you create more jobs. In South Africa, where I live, for instance, there's 40% unemployment. And amongst the youth, it's as high as 60%. So unless there's a thought process that is very focused and directed at how you actually get these losers, as has been said, to globalization into being winners, with that thought process, that may certainly impact us. In the short term, of course, the commodity prices for some of the key energy producers and mining sector producers are going to be a factor. But I don't see that as being too much of a factor for the very reasons that I gave in my introductory remarks, that a lot of the growth is now moving beyond pure commodity growth. And then even if it did, you also see a wide dispersion of different commodities. For instance, if the miners are losing, the agriculturists are gaining. Cocoa prices, for instance, are at the highest. So the Ghanas and the Cote d'Ivoires are likely to be, probably positivists on that side.
Thank you. Dr. James.
In the short term, the risk is the change itself, the rapidity of the change. In many countries, we look on a very sharp decline in oil prices as a tax cut and a boost to consumers. And globally, if you're modeling the global economy, you would see it in potentially as a net positive, but the change itself creates uncertainty. And uncertainty can create economic paralysis, and it certainly has huge financial consequences. So the sheer uncertainty of the outlook for energy markets, a very, very key market globally, and its knock-on implications for financial markets is concerning. I mean, we can go through all the things, cities without people in China and all the ones that we typically list as the usual suspects, but it's the rapidity of change that worries me, because the resilience to adjust becomes difficult. That's a short-term thing. The longer-term thing, unambiguously to me, is the same as you've already just heard, and that is income equality. Inequality growing. It's growing in the U.S. It will grow in Europe. I mean, if you leave a generation behind in Europe, you will have income inequality. If you look at the U.S. housing market and the fact that it hasn't improved more, it's because the 25 to 34-year-old group is simply not in the market in the way it has been in the past, because they can't be in the market the way they can be in the past. And I think it leads to the point that we've got to realize that economic gains, economic growth, prosperity are team sports. And they are not, it didn't used to be team sports. You know, when I think about 100 years ago when I started economic analysis, you thought about the US, or you thought about Europe, or you thought about Canada. And the linkages, well, for Canada, there was always a linkage to the US. But by and large, we used to think in country terms, and we can't anymore. And you talk about the Trans-Pacific Partnership or the various alliances that are coming through Asia, a new investment bank in Asia, which is fundamentally very, very important globally, and realize that that coordination, cooperation becomes important to us all. It's not out there. It affects us in a very material way, and that is the biggest risk, that we don't see things in international terms. We think about regionally, locally, what it means for us.
Thank you. Dr. Dams, your perspective, you would?
Let me add one element that I think has not been touched upon. Yes, and I'm going to focus on the long-term growth. What we should not forget, and I think it has been clearly shown in a recent study by the IMF, that the potential rate of growth is structurally declining. And we keep thinking that, yes, we're going to have spectacular growth, but the long-term trend for a long time, even before the financial crisis, was that there was a downward sloping curve in terms of potential economic growth. And that we need to look at three elements. We need to look, and you've referred to population growth, so we need to look at human resources, what's going to happen there. We need to look at capital resources. But most importantly, and continuously overlooked, is what is happening to productivity and to total factor productivity. And we have seen a number of the emerging economies that have been able to grow by taking over ideas, technologies from the advanced world and taking them. We have seen that that has worked well for them and has been doing well. But we see now today that the most advanced economies, like the US, like Europe, are hitting the technology frontier. And so I think in order to really, for the world to grow very fast, we will need to make sure that we can break that technology frontier and move further on. And it's something that worries me, because I thought with ICT we have really made a major step, and then you see that that step is not enough to break that frontier. The second point I want to make, and I want to join some of the comments that have been made here, that is on free trade and protectionism. I think most of the governments want free trade, but for other reasons they will be forced to reduce the motivation for free trade. That has to do with security, that has to do with terrorism, that has to do with food safety, and a lot of things that has to do with inequality. And so you see at the same time a motivation for free trade, but a lot of practical restrictions on trying to push down free trade.
Thank you. Dr. Justin, there's an upcoming Brics summit in July. Obviously that was a region that most of us has counted as a sort of a given that's going to drive us through the entire decade of growth. What is your perspective on the growth prospects for that region?
Well, on a near-term basis, when you go through the acronym, it's very mixed. And in fact, that's one of the key problems in the commodity space, is that the large countries that were going to power demand for commodities are performing in a very uneven way. Brazil is struggling with getting out of recession and moving forward. Russia, we know there's a recession. We're not quite sure how deep it is. There's an enormous amount of problems with that economy currently. India is moving forward. A balance of payments crisis is behind us, as opposed to in front of us, hopefully, and some structural reforms are there. And China is slowing down, but in aggregate, that region, and South Africa we throw in as well, very uneven performance. When you put it all together, that region in the medium term will still grow at a multiple of what we see in Canada, US, Europe, and Japan. That is the future. And they're enormous populations. So near term, very uneven performance, and we see it in spades in our commodity outlook and in a variety of other things. But the medium term, I have not lost faith in the fact that we are bringing the world to a different place than we have seen before, and that is a world where there are vastly more consumers, where we have vastly more opportunities in many industries than we have seen at any time in my lifetime.
Dr. Bitt, your perspective.
Well, I'm not that optimistic on at least three of the Brics. Russia never was a BRIC, right? It was an old industrial country that happened to have had the bad luck of being under communism for 80 years. So they had lousy governance and the wrong capital stock. Then they had the further bad luck of discovering massive natural resources before they had good governance. And so they wasted it. So, and then the combination of sanctions from Ukraine, oil prices down, and Putin capitalism means that the prospects are poor. Brazil used to be a BRIC, right? It's fallen off the BRIC wagon. Right? It's got the worst monetary fiscal policy mix in the known universe. Right? Here we are, supposed to be worried about pressing against zero lower bound for nominal interest rates. They have 12.5% nominal interest rates. They must be doing something wrong. So too tight monetary, too loose fiscal, and very investment unfriendly. And then they screwed up the supply side since the last year of Lula's reign, and they continue to do so. It's protectionist, inward-looking, it's 70s style import substitution policy. They need radical reforms to get growth back again. And for demographic reasons, they won't go back to the old style, but they could do a lot better than they are now. South Africa, I think, doesn't have the politics to permit rapid growth. It's until they change to a less clientelistic approach to politics. They won't have the saving rate and the investment rates that are necessary for rapid growth. China needs to get out of its old growth model into a more sustainable, domestic demand-driven, consumption-driven, services-driven, I can still breathe the air-driven growth, right? They're nowhere near there yet, but they are making the right moves. Can they do this without at least a cyclical downturn? I don't think so. I've never seen a country with a speculative credit bubble the size that China has, and a housing boom the size that China has, that got out of it without a cyclical contraction. So expecting that they will resume growth in the 5% range, which is where they are at the moment. Don't believe the official data. There are lies, damned lies and statistics, and then there are Chinese statistics. They really are laughable. And then lastly, India seems to be doing it right. Many challenges, but simply by not shooting itself in the foot every month, right? And but changing it to a quarterly basis, they have improved massively.
Thank you. Justin.
Well, I'll gently disagree with Willem on South Africa. But nonetheless, I mean, there are some internal challenges, but that doesn't take away from its role as a key driver of what's happening in the rest of Africa. I think right now, just as an example, the Public Investment Commissioner, which is the biggest pension funds manager in that country, is basically one of the biggest cross-border investors into countries in Africa on an equity basis in different formats. And then, when you look at that one side, and then you also look at one key thing which I didn't discuss in my earlier presentation, the China factor for us. China may continue to grow at 5% or 3% or whatever it is, but China's impact has been twofold. On the one hand, apart from being a big buyer of the commodities, it's also been completely a game changer in the infrastructure space. I mean, I traveled to about 44 of the 54 African countries, and I can tell you in some of them, there's been a total change from, say, 10 years ago when I used to go to these places, from airports to ports to bridges to roads. So in terms of what's happening, yes, China may not have it properly, but it's certainly a game changer in terms of what's happening. And then, of course, India will share the same view on that. I think India is also quite a positive driver for us in terms of the things that are likely to happen on the continent. But I still don't see it being as impactful as China, for instance.
Thank you.
I'll be very brief and precise. The Brics concept for me is completely dead. The fact that two speakers have to go country by country to describe it means it has no content at all. It was created 10 years ago as a marketing concept, but for the rest, there is no substance to it, in order to be precise on what I mean.
Thank you.
Well, speaking, once I have you on the mic, I'm not going to let you off that easily, but you made a comment in your introductory remarks to the exams about Eurozone policymakers actually for change helping the Eurozone and with respect to the monetary policy. What else can be done, and what do you think will be done to boost the outlook in the Eurozone in 2015?
Honestly, what I think should be done will probably not happen, but at least let me give you my idea. First of all, one of the big issues we have to do is political uncertainty or policy uncertainty, and that's creating some negative effects also on capital expenditures. But what I think should be done, the European Union has now imposed a number of very strict measures on government spending. I think that is correct. But one of the disadvantages of that is that it's extremely difficult for governments now to make a distinction between what is necessary for the current operations of the government and for the investment operations, the investments in infrastructure and so on. And if Europe cannot separate these type of government expenditures, we will face a big issue later on, because Europe is not making the infrastructure investments that should be made. European Union is trying to solve that by making investments possible at a European Union level. I don't think that's the right level. That should be done at the country levels, but that remains a big challenge. So I'm really advocating a system by which you would have current budgets and you would have capital budgets separated. Will it happen? I don't think so, because they will not have the political will to really let then some governments spend a little bit more than they should be doing. But that is, I think, what Europe really needs.
Thank you. Dr. Jessen, your view?
Just in general terms, well, if I'm looking at the outlook for Europe specifically, the thing that worries me now, and it was a worry when the US was involved with quantitative easing, is that we now have influenced the markets in a way where risk pricing has basically been taken out of the equation. And for example, across the bond market spectrum, European countries can raise money substantially at a 10-year term, let's say, well below what it would be in the US. And getting interest rates down is wonderful in terms of forestalling debt problems. It basically buys time. Governments, therefore, are beholden not to squander that time, but make the adjustments. And when I see what's happening currently in Europe, and for that matter in Japan with policy, I don't see an easy unwinding of it. Two, we have hooked people on a drug called zero interest rates, or close to that. And three, the adjustment higher, it will cause enormous surprise for people that are under 35 years old that think these rates are normal and are likely to persist for the rest of their lives.
Thank you. Dr. Buter, quantitative easing in Europe, would that be enough to help offset the deflationary pressures?
No, it's a minor bomb on a big wound. It helps, but it doesn't really solve the problem. Europe needs, I think, first is to get rid of the centrally imposed fiscal constraints. They're politically illegitimate because there is no real supranational authority that it destroys support for the European Union as a whole. I think we ought to have a rule in Europe that you break it, you own it. If a sovereign can't support itself, you have to have an orderly sovereign debt restructuring mechanism, not like Greece, but something that can resolve sovereigns the way we can resolve banks. But second, we need a stimulus in the periphery, a fiscal stimulus, funded directly by the central bank. Basically a form of helicopter money, but through public spending, on infrastructure preferably. Although the interesting thing is, the periphery is actually better endowed with infrastructure than some of the core. Yeah. Some of the most rubbish infrastructure is in the west of Germany, Belgium not that great. I used to live 19 years until 2013 in the UK. I thought UK infrastructure was rubbish. Then I moved back to New York. And then I really knew what was rubbish. The US has underinvested in infrastructure for decades. And if this country doesn't wake up to the need to do something about it, right, then I think that any chance of being a major player, a global leader, is gone. All right? I mean, this is very important. And then Europe needs the stimulus, monetized fiscal stimulus, and then supply-side reform, for God's sake. The labor markets in Europe is arena for intergenerational warfare. Right? In most countries, including the US, we have intergenerational warfare through the Social Security budget. Right? The US has a great welfare state for the old, Social Security and Medicare, and nothing for anybody else. Right? In Europe, we have that too, but we have the additional problem that, you know, as a young person in Southern Europe at the moment, you have the choice. You become unemployed, you emigrate, or you become a day laborer. All permanent jobs are held by Papa and Mama. And that is totally unacceptable. We are really disenfranchising a generation. Fortunately, my kids are this side of the pond. You know, they have the passports to do that. But I wouldn't want them to try and make a go in the labor market in Spain or Portugal or Italy.
Justin, your perspective from an outsider?
I certainly will defer to my more learned European friends on that. But as an outsider, we certainly, from the African side, are not seeing the same historical relationships, if you would put it that way. The European element is certainly wilting. I still go back to my point about China. Unless there's a critical understanding of what they are doing and what is happening in the African countries with China, I think it will be difficult to sort of understand the paradigm shift that has happened towards this relationship.
Okay. Well, the final question I have for all of you, 30 seconds each. What do we like the most? We're speaking to the investors. Do we encourage them to invest in the US, Europe, emerging markets, Africa? Oh, I know where your vote goes. But what do we send the investors with the money?
If you're talking equities, the US is the strongest market. If you're talking fixed income, it's probably the safest. Or take a home country bias. If you're looking at infrastructure, it's definitely the emerging market space. And in fact, I think that's going to be a driving influence and opportunity for investors for some time.
Thank you. Justin, just for the laughs.
Well, there's, the World Bank and everyone estimates there's a $70 billion deficit for African infrastructure on a per annum basis. So even if you just closed your eyes and looked at this continent that's been growing over the last 10 years at 5% on average, and with some countries within that growing as high as 14%, I would say there's a pretty good reason why people should be looking at the infrastructure side of that.
Let me take a little bit of different view. I've been a long time in private equity and venture capital, and the lesson I've learned, never go with the flow. Go with what you know and what you understand. So even if you see a lot of things happening in this country or in that country, if you don't know that country, don't do it. You will be making money if you stay with the things that you know and understand, and then you're going to be successful.
Well, ever since I sort of crawled out of graduate school, I've only had one investment strategy. It's the most globally diversified equity portfolio I can find, and I haven't looked back, and I won't look back until they nail the lid on my coffin and my kids distribute the spoils.
Couldn't have thought of a better ending to that myself. Gentlemen, thank you so much for sharing your uniquely valuable perspectives. Ladies and gentlemen, please acknowledge our distinguished speakers. I'm going to ask you to stay on stage. And while we stay on stage, I'm going to invite Marcos Buscaglia to help us close our plenary session.